Hi, everyone. Thanks so much for joining us this afternoon. So just as everyone's kind of settling in, I want to ask or see a quick show of hands if we have any RPA tool users with us today. If so, let us know in the questions section of your GoToWebinar control panel. It should be located on the right-hand side of your screen, but it could be different for everyone. You'll be able to submit your any kind of questions you have or comments or anything that you would like us to hear, via the questions section. And then I will also be sharing some helpful resources using the chat section. So two different areas, but we can get used to it by if you let us know if you are an RPA tool user or if you're not one quite yet. And then if you're, like I said, if you're not currently an RPA tool user, we still love to hear where you're tuning in from. So Cindy and I are tuning in from the Midwest area, and Craig is joining us all the way in the West from Utah. So you can use that to let us know where you're located. All right. We have a lot of stuff to cover today, so I don't want to spend too much time, so I want to get started. So hello and welcome to this afternoon's webinar, How to Test Retirement Decisions Before You Make Them, led by Craig Israelsen and Cynthia McLaughlin. Thank you so much for joining us. We are happy to have you all here. So my name is Jennifer Shear, and I'll be your host for today. I personally have been really looking forward to this event, as we love working with Craig and enjoyed the AAII retirement seminar project that we worked on last year. And today is going to be actually an interactive demo with a presentation where Craig is actually going to go over how to stress test retirement decisions before you make them using his proprietary tool, the Retirement Portfolio Analyzer, also commonly known as RPA. We might use that throughout the webinar. And as a thank you for attending today's event, we are offering all our attendees a special discount on the RPA, as well as our AAII retirement investing newsletter. So please stay tuned for our presentation. But before we begin, there are a few things I'd like to go over. First off, I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. If you want to view our full disclaimer, please visit aaii.com/privacy/disclaimer. And like I said before, please keep an eye on your chat section throughout the webinar, as I'll be sharing some helpful resources and links that pertain to today's content. And if you have any questions for our speaker during the presentation, you can submit them using the question section of your GoToWebinar control panel. And then once our presentation concludes, Cindy will select a few for Craig to answer. And then if your question isn't selected during the broadcast, we'll try to get to as many as we can, but we're gonna, we're gonna try to stick to about an hour timeline. So if we don't get to your question, please feel free to email us at members@aaii.com. And then our presenter slide deck is available under the handout section of your GoToWebinar control panel, and that is located on the right-hand side of your screen. Please visit the GoToWebinar website for support at gotowebinar.com if you experience any issues with your audio or video during the webinar. And just as a friendly reminder, because we get a lot of questions about this, but the presentation is being recorded, and a replay of the webinar will be available on our YouTube channel, as well as on our website at aaii.com/webinars. And in this webinar, Craig will cover a few things such as what's new in the RPA tool and how to use it for 2026, how to stress test your retirement plan with the RPA tool, common retirement mistakes and how to avoid them, and why the RPA tool matters for long-term planning and life changes. And as I mentioned before, we do have a special promo, so I'll be putting in the chat a little bit later, but I do want to preface that AAII members and anyone who's affiliated with AAII can get the RPA for just $100. It's regularly priced $150 online just for attending today's presentation. And you can find Craig's order form in the handout section. I put that in earlier this morning, and that you can use that to purchase the RPA. You just have to fill it out and email it to Craig at craig@aai.com. And then be sure to mention that you're affiliated with AAII. Just put it somewhere in the email to get your discount. And then, I know that's a lot to digest. So of course, don't worry, I'll be putting it in the chat section and any kind of helpful links. And then we'll also include it in that follow-up email that you'll receive for being an attendee. So I'll put everything in there, so don't worry. And with that, I'd like to hand over the presentation to Cindy.
Oh, hi, thank you for joining today. We really appreciate how generous you are with your time, and I wanted to introduce myself. I'm Cindy McLaughlin, and I am the lead editor of AAII's Retirement Investing Service. So if you're a subscriber, thank you very much for subscribing. And I'm always interested in comments, feedback, content suggestions. Please don't be shy. So on to Craig. I want to give a little more information about Craig. Craig Israelsen has earned a Ph.D. He is a frequent and contributing editor for our AAII monthly journal, and he is the creator of the Retirement Portfolio Analyzer, which is the focus of today's presentation. He's also developed the 7/12 portfolio, and he is an author of 3 books, including 7/12, a diversified investment portfolio with a plan. So Craig, thank you for joining us, and we're looking forward to learning more about the tool and what is new with the tool for those who may be familiar with it already.
Super. Thank you both, Jenna and Cindy. Appreciate your kindness. So as Jenna mentioned, the title is kind of a long title, How to Test Retirement Decisions Before You Make Them. And the value of the RPA tool that has been referred to is that it does exactly this. It lets us change a lot of variables that we actually have some control over and assess the impact. So let me first show you this little slide. Just a couple of weeks ago, I returned from Tanzania, where with some friends of mine, we were able to hike Mount Kilimanjaro. This slide is not, this picture is after we had reached the summit and we're coming down, not too far from the summit. This is my favorite picture, and it might be surprising to people. Well, why isn't the actual summit your favorite picture? Just because it's not. This one to me is much more descriptive of, when you reach the summit, you think, hey, the job is done. It's not. You have to get down. And so we are now beginning our descent that is going to ultimately result in descending about 14,000 feet. So the reason I'm showing this is, I guess, one, to share just a neat experience I had. But the other is that retirement is really, the retirement metaphor is so logically connected to the idea of descending the mountain. And the descent is really important, how things play out. So that to me is what the RPA tool has personally helped me with, because I'm at the age where I should be retired, and the RMD starts kicking in not too many years. So with that, let's just proceed and ask 2 questions. Number 1, will my portfolio balance decline during retirement? And secondly, will I run out of money in retirement? And sometimes these questions, the first question is not as frightening as the second question. The second question is legitimately frightening. And I hope by the end of our conversation today that it'll be a little bit less frightening, because we can do a lot of analysis to gain some confidence that, as best history can inform us, that the likelihood of running out of money is quite small if we follow some basic guidelines. So you don't have to read all this. I'll just tell you that we're studying a bunch of rolling 25-year periods, all the way back to 1926. So basically, over the last century, from 1926 to 2025, there are 76 rolling 25-year periods. And so I'm going to really dial in and focus on these 25-year periods, because they represent pretty well the length of time we spend in retirement. That would take us from age 70 to age 95. Most of us will expire, our mortal life will expire sometime in that window from between age 70 and age 95. I know that we all know somebody who's 103. I get that, but we're looking at in the main, this 25-year window captures quite adequately our experience as a retiree. And if you're still not convinced, think of it this way. If you still have, as we look at the analysis in a few slides, if you still have quite a bit of money in your retirement account at age 95, let's say that we start our analysis at age 70, if at 95 you still have a lot of money, pretty likely that you'll have that money for a few more years. Even though the RMD is cranking up and the percentage is increasing, if you've made it 25 years with a balance that in all likelihood is larger than your starting balance, pretty unlikely you're going to run out in the next 4, 5, 6, 8 years. Okay, so all of that said, what we're really doing is we're analyzing sequence of returns risk, because sequence of returns risk is a unique risk that is experienced primarily when we are taking money out of a portfolio. That's when sequence of returns risk is most pronounced. And that's essentially the retirement scenario. So to our first question, how often historically was a 60-40 portfolio, so 60% stock, 40% bonds and cash, how often was that type of portfolio larger at age 98 than the starting balance at age 73? So now I've just advanced, instead of 70 to 95, I'm saying, what about 73 to 98? The reason for that change is obviously the RMD kicks in for those of us going forward now at age 73. I'm assuming a portfolio cost of 125 basis points, which may horrify some of you because yours is way below that. But I wanted to introduce an additional stress to the portfolio. I'm not trying to baby or coddle this analysis. I'm trying to stress it, in fact. So I understand that many of you have created a portfolio that has overall cost maybe 25 basis points or 30 basis points, and that's fantastic. So here are a couple of answers to the question, how often did your portfolio grow? Well, if the RMD is the determiner of how money is being withdrawn, your portfolio was actually larger after 25 years of withdrawals, 80.3% of the time. That's what the analysis over the last century tells us. And again, this is 76 rolling 25-year periods. So 80.3% of those 76 rolling quarter century periods, the portfolio had grown larger. And that's after taking a lot of money out. If the withdrawals are a 4% rate every year, meaning literally, so this can be confusing because of the famous Bill Bengen 4% guideline thing. This is a very straightforward version of the 4% rule. At the end of every year, you take 4% out of the portfolio. Whatever its balance is, you take out 4%. Okay, that's what I mean when I say the 4% rule. And there's different interpretations of and different methods of what's called the 4% rule often isn't what I just described. So let me show you some details on this. So here's the 60-40 portfolio. Here are the two stats that I've already shown you, the 80.3 if the RMD is driving the withdrawals, the 4% rate, 100% of the time the portfolio had grown after 25 years of withdrawals. What about a 5% annual withdrawal? Well, just shy of 95% of the time, the portfolio has grown. So back to that second question on the opening screen, you know, what's the chance we're going to run out of money? We haven't even addressed that yet. All we're talking about here is, has the portfolio grown? The idea that it's depleted is completely foreign to these numbers right here. These numbers are incredibly encouraging. And so obviously, if it's grown, it hasn't been depleted. I mean, I know that you know that, but that's the obvious flip side of these numbers. What about a portfolio that's a bit more conservative? So it's 40% equity, 60% fixed income. And here's the actual sub-allocations right here that you can see. Well, this is interesting because the difference now between a 60-40 and a 40-60 is pronounced if the RMD is the driver of how money is being withdrawn. Our success rate of growing the portfolio is basically cut in half. You can see that. Whereas if in a more conservative portfolio, we're taking out 4% a year or 5% a year, there's not a whole lot of difference in the results after 25 years. Basically, a 4% withdrawal rate, this thing's going to grow, this portfolio. And a 5% withdrawal rate, you're just below 90% of the time it grew. What about a more aggressive retirement portfolio? So you have 80% equity, 20% fixed income. The RMD now is dealt with quite nicely. Almost 91% of the time, your portfolio is larger after 25 years of RMD withdrawals than it was when it started. It doesn't matter what the size of the portfolio is. It could be 100,000, 500,000, a million. It doesn't matter because these are percentage-based withdrawals. The only thing that matters in terms of the size of the portfolio, how many dollars are in it to start with, well, that will obviously determine how much money you withdraw. But we're talking here about the rate of success in the portfolio growing larger over time. And clearly with an 80-20 portfolio, a 4% or a 5% withdrawal rate is not even coming close to taxing it. It grew every time in all 76 rolling 25-year periods. So here's a couple of takeaways. Number one, if the RMD governs your withdrawals and you want your portfolio to grow, and that second part, the and you want your portfolio to grow, that almost sounds like a smart aleck kind of statement. It really, it's not meant that way. I certainly have the capacity to be a smart aleck, but the idea here is that I'm trying to acknowledge that some people actually they may want to liquidate it. They want to spend it all. And that's up to them. In this case, I'm making an assumption that you do actually want it to grow for legacy purposes, for whatever. So if both of those statements are descriptive of what you would like to have happen or what is happening, number one, the RMD is driving withdrawals, and two, you want it to grow, you need a larger equity allocation. These numbers, they're basically just shouting that. So that's takeaway number one. In other words, the way you withdraw money, the way that you're, in this case, being forced, because it's the RMD, that needs to inform, to a certain extent, your asset allocation. By contrast, point number two, if you have a large balance of retirement monies in accounts that are not impacted by the RMD, so you have just brokerage accounts, you have Roth IRAs, money in a savings account, money in checking account, it's not RMD impacted, then, and you intend to use a very straightforward withdrawal rate, such as 4% or 5% annually, and as before, you want your portfolio to grow, then the asset allocation is not as critical. Because look at your success rates. They're very similar. Whether you have a 40-60 a 60-40, an 80-20. You can be conservative if you want to dial it down more to a 40-60. That works. You have very high success rates. And again, these success rates are not, did the portfolio survive? No, this is a higher bar. Did the portfolio grow? And I'm guessing that of the people that are now on this webinar, this almost sounds like some sort of fantasy island. How can this be true? Because I would guess that it's not uncommon for people to sort of visualize their retirement portfolio like a barrel full of water, and the water represents money, their retirement account balance. And the withdrawals represent a hole in the bottom of the barrel with a cork, and we pull the cork out and water flows out, and that's our withdrawal. And then we put the cork back in, and time goes by, and what happens to the barrel? Well, if you're draining it, obviously it has to empty. But what are we forgetting? We're forgetting that our portfolio is invested and it's replenishing itself. It's as if there's a pipe coming from the bottom of the barrel, it goes up, comes back down into the top, and water is flowing from the barrel back into the barrel. It's regenerating itself. And this visualization, I think, is quite helpful because it should be rather intuitive that if the barrel is regenerating and replenishing itself faster than it's being withdrawn, then money is flowing out, that it will at least stay steady or will grow. That's what these results, this analysis is exactly saying. So, next point. How often was the portfolio totally depleted? This is my favorite slide because it's pretty straightforward. That would be never. And again, I've looked at every rolling 25-year period for the last century. I cannot find any of them where the portfolio is depleted. And the reason for that is that we're using a percentage-based withdrawal. And a percentage-based withdrawal means that after a year like 2008, which I don't have to explain, we all remember that, the withdrawal will likely be smaller, the actual cash amount of money withdrawn. Even though in the case of the RMD, the percentage will have increased from the prior year, the decline in the portfolio balance, if the portfolio had a material stock allocation, causes the balance to go down. We implement the percentage-based withdrawal, and the amount of money withdrawn is now smaller than it was at the end of 2007. That very fact of how the mathematics is simply playing out allows the portfolio to somewhat recover. The contrast to that is a system of withdrawals where a cost of living adjustment, or a COLA, is mandated every year, so that the withdrawal has to be the same or higher in terms of dollars, actual dollars withdrawn, than the prior year. That method is very different than what I'm showing you here. That method of forcing an increase has the potential to deplete a portfolio. A percentage-based approach does not deplete a portfolio unless the percentage is ridiculous, like 12% a year. Okay, well, that's ridiculous. So when we're reasonable, a percentage-based approach has the capacity to preserve a retirement portfolio. So point number 3, perhaps we might stop worrying about running out of money. If the portfolio is prudently built and rebalanced annually and the withdrawals are reasonable, we just won't deplete it within 25 years and likely not within 35 years. So let's let me show you a couple of screens that will give you a sense for those who might be new to the RPA or the Retirement Portfolio Analyzer. Let me show you some, this is the most, I guess, important screen in my mind. So this is a spreadsheet-based tool, based in Excel, runs on the PC and on the Mac, if the Mac has Excel for the Mac. And in the bright yellow cells are where the user enters their own specific data. So I've just pre-populated this. This is a screenshot. I'll fire up the spreadsheet here in just a moment so you can see it live. So the current year is 2026. The retirement portfolio account balance in 2026 is $1 million. Your current age, this is just a really simple scenario, is 73. Withdrawals begin at age 73. And then the asset allocation is in these next 4 slides. You have a 40% stock allocation in large US stock, 20% in small US stock. This could be using index funds, this could be using ETFs, whatever the instruments are that you're actually investing in. There's a 30% bond allocation and a 10% stock allocation. Here's the total cost of 125 basis points. Obviously, we can adjust that, but I'm trying to synchronize this screen with what you've already seen on the previous slides. And the withdrawal method is the RMD right here. Okay. So again, everything in bright yellow is adjustable, is changeable by the user. And then over here, we have kind of an interesting little section, which is the opportunity, if the user chooses, to modify historical returns. So for example, over the last 100 years, large US stock, which you all know is the S&P 500, that's the index, that's the measure of large US stock, the most prominent measure. That raw index return is 10.49%, right there, 10.49. And it has a standard deviation or a volatility measure of about 19.6%. So the volatility is roughly twice the size of the return, the average annualized return, which by contrast, small stock has had a higher average return over the last 100 years, 11.05%, but has had a standard deviation of 30.39. Whoa, so that's almost a 3-to-1 relationship between volatility and return. That's part of how large and small stock are different. Small stock gives you a little bit of a bump in performance, but it's a little bit more of a roller coaster ride. Whereas bonds have averaged about 5% return, the aggregate bond index, and a standard deviation of about 6%. So a very different volatility experience. And then cash has averaged 3.3% with about a 3% standard deviation. So that is not a roller coaster. That is a very sedate ride at the county fair. But there's the trade-off. Lower return, dramatically lower volatility of returns. And I don't want to necessarily, beat this horse to death, but when you look at a portfolio and its performance metrics, so for example, this 60-40 portfolio, 40-20, 30-10, that's a 60-40. That portfolio right over here has averaged 7.73% over the last 100 years. Now, that's including the 125 basis points of cost. So if we change that, that will go up. But obviously, cost is real. Cost comes out of our pockets as investors. And the standard deviation is 13.45, right over here. So I suspect most of you, if you have a financial advisor or if you do some of your own analysis, that you've either been told the standard deviation or you've calculated it yourself. And then the question comes, okay, what does that number mean? You know, like 13.45 standard deviation. Is that low? I mean, how do you know? What's the intuitive scale of standard deviation? Well, that's why I wanted to point this out. A low standard deviation is 3. A high standard deviation is 30. All you have to remember are those two numbers. 3 is low, 30 is high. So where's 13? 13 is relatively low. It's well below 30, kind of in that mid zone. But now at least you have some benchmarks of what does the standard deviation even mean? And then, of course, the return, that's a bit more intuitive. A lot of people walk around thinking, I'd like a 10% return. That's what I want my portfolio to do. Where the heck does that number come from? Right here, the S&P 500, 10.49. That's where that number comes from. That sort of man on the street, ask him, you know, what return do you want in your portfolio? And he says 10. So 7.73, we kind of have a natural intuition for returns. I argue we don't have much natural intuition for what's a high and a low standard deviation. Okay, that was a little side trip on performance metrics. So what do we know about this portfolio over the last 100 years if the RMD is determining the withdrawals annually? We know this. Now I'm in the green section. The average withdrawal per year was about $109,000, call it $110,000. Now that's the average withdrawal over 25 years. So it's not 109,722 every year. It would be a smaller withdrawal in year 1, a much larger withdrawal in year 25, because two things are happening. The RMD percentage is escalating and the portfolio balance is growing. How do we know it's growing? Well, we look over in the blue section. What was the average balance after 25 years? It was 1.5 million. Whoa, that's the average. What was the start? The start was $1 million. How often did the portfolio balance grow? 80.3% of the time. How often did it survive, meaning it had a positive balance above zero? 100% of the time. How often did the withdrawals increase year over year? Now I'm back in the green section. 71% of the time. Oh, interesting. That's one of the most interesting things on the screen, because we know the RMD percentage is increasing. And so sort of a casual thought about that would be, oh, well, if that's the case, and my portfolio is growing based on the average balance, then I would suspect that the withdrawals annually would increase nearly all the time. That's not the case, because you have ups and downs in a portfolio like this. You know, it doesn't always have a positive return. It has a positive return about 75% of the time, which is pretty amazing. And then the last little metric on this opening screen is the question: how often did the withdrawals keep up with inflation? 90% of the time. The RMD is really good at keeping up with inflation, by the way. Why? Because it's escalating. Percentage is increasing. Now I'm going to go to a new screen, and the new screen is going to be a 4% withdrawal. There we go. So everything stayed the same, except I went from RMD, which you're seeing now, and let's just kind of make a mental note. The average withdrawal was, call it 110,000, and our average balance at the end of 25 years was 1.5 million. Let's just kind of lock those into our head. Oh, now if we go to a 4% annual withdrawal rate, we drop from 110,000 average annual withdrawal to 76,000. But our portfolio balance goes from 1.5 million to just shy of 3 million. I mean, this portfolio got big. Why? Because a 60-40 portfolio is producing, on average, almost an 8% return and we're only withdrawing 4%. So what do you think is going to happen? It's going to grow. I mean, that's the easiest way to just kind of visualize this barrel, this retirement barrel. If more is coming in than going out, this will grow. So then we have nothing to worry about. I wish that was the case. What we worry about is the sequence of returns risk, meaning the year that we start withdrawing money, the stock market crashes. That's what we still have worries about. So then the question is, okay, while that's distressing, does that sink our plan? Are we just toast? The answer is no, because that's what's been analyzed in front of you. That's already been taken into account when you look at and study and analyze the last 100 years. There have been plenty of years where there was a drop in stock returns and a drop in both large and small stock returns. We've had a couple of years where bonds did poorly. 2022, most recently, bonds did horrible. All that's been evaluated. And we still get these impressive results. How is it possible? Well, here's the real caveat. All of this analysis assumes that the retiree, the investor, stayed in the portfolio. They did not bail out. That's a huge caveat. But it's also a reminder that that's how we get long-term results, is by staying with the plan long-term. 18 months is not long-term. 3 years is not long-term. We're analyzing 25-year periods here. And so I can't stress that enough, that these results are based on a person staying in whatever portfolio they design here, that the input. Okay, there's the indexes I use. That's actual historical index-based returns. Let's do this. Let's actually go to the RPA tool right here. So this is what you were just looking at, but this is live. You were looking at a PowerPoint screen, a screenshot of the spreadsheet. So now I'm going to do some fun stuff. I'll leave these assumptions as they are from what you've seen in the screens before, but I want to demonstrate a super conservative portfolio. So all cash. All cash. And you think, well, cash, then I have no risk. Yeah, I wish it was that simple. There is no risk-free position. It's just a function. Our decisions basically determine what risk we're going to be exposed to. It's kind of like saying, I'm going to drive my car from here to there, but I'm going to do it in a risk-free way. Sorry, driving a car is not a risk-free proposal. And so then we take steps to make it less risky. That's a good idea. Well, so one thought is then, as an investor, well, I'll take the big step to make it less risky. I'll just be in all cash. Okay, well, if that's the case, you wouldn't likely be paying 125 basis points. Maybe let's put 20 basis points as the cost. That'll help a little bit. So the average withdrawal was about 56,000. Okay, that's something. 67% of the time the withdrawals increased year over year. Less than half the time we kept up with inflation. That hurts. The average balance after 25 years was below 500,000. So that's a real change. In the 60-40 portfolio, our average balance after 25 years was almost 3 million. Now in this quote, risk-free portfolio, we still have money. It never grew. There's never a 25-year period where the portfolio grew, had a larger balance after 25 years, but it did still have money 98.7% of the time. So that means there was a failure, and it was right here in this graph. Whenever these lines dive down to the x-axis, that means in this case, in year 21, the portfolio was depleted, no more money. So we did have a failure rate. Why? Not because of the RMD, but because of the asset allocation. So person might say, well, then I'll do 50 bonds, 50. Okay, well, that's a little better. So our average balance after 25 years went up to 632,000. 25% of the time, it was larger after 25 years. The average withdrawal increased a little bit. We kept up with inflation a little bit better. And our withdrawals increased year over year, roughly 3/4 of the time. Okay, that's an improvement. We still have a very conservative portfolio that averaged about a 4% return with about a 4% standard deviation. Okay, now it's not my job to tell a person how to build their portfolio, but I would suggest, would you consider a modest allocation to stock? Okay, let's do then 20% in large stock. That means we have to reduce bonds and cash down to 40-40. All right, well, that improved things. Now you're at 874 is the average ending balance. Roughly a third of the time, the portfolio actually grew. So this is what I'm talking about in terms of test driving the impact of choices that you have. You have a choice in your asset allocation, whether you're determining it or collectively with your advisor, you're determining the asset allocation. Those are decisions you can make. And you can make them in the context of exposing that decision to the last 100 years of actual returns of the indexes that reflect how most of us actually invest. We invest in large cap US stock. We invest in small cap US stock and so forth. So that's the quick view of the impact of different choices we make, whether it be changing the cost structure of the portfolio, whether it's the asset allocation, whether it's the historical adjusters. And let me just give you so let's just adjust the returns of bonds. Let's go to -50. Okay, so we just took 50 basis points off the actual historical return of bonds. We literally changed history. And then we assessed what was the impact. Well, let's go back to zero. So our average withdrawal was just under $78,000. If we say, you know what, I want a different historical reality, because essentially we're using this type of historical analyzer to cast a shadow of what to anticipate going forward. We're not saying it's absolutely predictive, but to suppose that the next 100 years is completely different than the last 100 years, if that's the case, if you believe that, then you have no interest in historical data, none, because it reveals nothing to you, because you believe the future will be completely different. If, on the other hand, you have a sense of, I think history is going to rhyme with the future, though not be completely predictive of the future and the timing. 100 years of historical data doesn't give us much to go on as to what's going to be happening over the next 6 months. But it does give us quite a bit to go on of what might be happening over the next 20 years. That's what I would propose is the value of historical data. So if I take the 50 basis points off the historical return of bonds, let's pay attention now to this 77,925 goes to 75,750. So what we've just demonstrated is if you believe that the future return of bonds will be lower than the historical return, you just modeled that. You just modeled your a bit more pessimistic view of the future based on a modified past. I know this sounds like Marty McFly and Doc and Back to the Future because we're going back and forth, but that's essentially what this adjuster allows you to contemplate. And the question is, if bonds don't do as well going forward, does it sink this portfolio? Does it kill this portfolio? No. That difference in the average withdrawal was pretty modest. It doesn't have that big of an impact. And this was a portfolio that's 40% bonds. So obviously, if you have a portfolio that's very heavy in one asset class, and then you also introduce a reduction of the historical performance, then you'll see a more dramatic change in the metrics reported on this screen. Now, as important as this screen is, I would suggest that there's another screen, it's the budget tab, that's even more important. Because this screen right here is really just dealing with the portfolio, your retirement portfolio, whatever the amount is, and the associated variables that accompany that portfolio, the asset allocation, the cost, and the withdrawal method. But the budget is the vital other side, which is acknowledging I don't have, my only source of retirement income is not simply my portfolio. Ah, of course. So we begin with Social Security. What is your Social Security? Well, let's say it's $3,000 a month, and the spouse is $1,500. Let's call it $1,400 a month. All right. And you enter like a 3% COLA or whatever, 2% COLA, whatever you want to enter in. When does the benefit begin for this earner, the highest earner? If it begins in year 3, you put 3, and there it is. In year 3, it begins right there. The other earner, their benefit began in the current year, 2026, but then when the higher earner started claiming, then there was a spousal benefit. And so this is a new feature of the RPA. You can enter when is there a spousal benefit. In this case, it was year 3. If the highest earner begins in year 4, then you would change this to year 4, and there's your spousal benefit, which is half of the higher earner. So that's just meant to simplify the way that you can get a more accurate appraisal of what the Social Security benefits are. That becomes a major source of income for this retiree or this couple that's retiring. So remember, bright yellow cells, that's where your data would be entered. Then in this column, we have an opportunity to enter any annuity income. Let's say that there's an annuity of $250 a month. And this can continue, it's a lifetime annuity, and you're gonna say, well, I'm gonna live to be 97. Okay, great. So now you've got that little annuity income factored in. Is there any other retirement income? Yeah, there is. There's $750 from this little job at the bait and tackle shop down on Main Street. I'm going to do that for the next 5 years, let's say, and then after that, I'm going to hang it up. Okay, so that's now entered. Well, based on the information that you've already entered, the RMD is the driver of how money is coming out of the portfolio. So that is reflected right here in this next column. These are the RMD withdrawal rates, 3.77, 3.92, 4.07, and so forth. Come all the way down in year 25, your RMD is 12.82%. Whoa, that is a high but it takes 25 years to get there. Here's something interesting. If I highlight that whole block of RMD withdrawal rates, then I come down here, this part of the screen tells me the average is 7%. So that's kind of intriguing. The average RMD for the first 25 years of the RMD is 7%. And I don't know that necessarily means anything amazing. It's just that you wouldn't want to say, oh, well, then my results using RMD will be the same as if I just put 7% as the fixed rate of withdrawal each year. Those are not the same thing. 7, that's the withdrawal rate out of the gate in year 1. Oh, that's kind of a heavy hit in year 1, particularly if you have a sequence of returns event like a 2008 happens to be your first year of withdrawals. So the magic of the RMD is that it averages 7%, but it gets there step by step. And that step by step is important because that's kind of, oddly enough, that's a merciful aspect of the RMD, that it slowly increases over time. I know that it's pretty common to have negative emotions toward the RMD, but it's not really the mathematics that we don't like. It's the fact that we're forced to take a withdrawal. So it's helpful to segregate your angst and leave the mathematics out of it and just focus on, yeah, I don't like being forced. Okay, I think we all get that. Okay, so now you've got Social Security income that's now been taken into account for both the higher and the lower earner. And you know, I say higher and lower, they may both have the same Social Security income. I mean, I just had to title these columns somehow. Another source of income is the annuity. Another source of income is other income. And finally, the 5th source of income is right here. This is the withdrawal from the portfolio that you've built in the prior tab right here. This 20% stock, 40% bond, 40% cash, that portfolio. Now, for this analysis, now that I'm showing you the budget tab, I'm going to go back to the 60-40. I think that's probably more reflective of how a lot of retirees invest. So now we've got this average withdrawal in year 1 from the portfolio, the 60-40 portfolio. The average withdrawal in year 1 is $3,145. That's based on all the historical analysis. It looks at all of the year 1 withdrawals and then averages them. The next, in year 2, the average withdrawal in year 2 based on the RMD was $34.82. And you can see all the way down. So your average withdrawal in year 25 was just under $22,000. Whoa, is that just a function of the high withdrawal rate? No, that's a function of, I'm just scrolling over fast here, the estimated balance in year 24, the year before, was $2 million. In other words, the starting balance is $1 million, and we kept it $1 million the whole time. But by year 24, on average, the balance of this portfolio had doubled. So you have the doubling of a portfolio plus the escalating of the RMD leads to very large RMD withdrawals in year, in this case, 25. Now, because the RMD has been selected, this column right here opens up. It's not visible unless RMD has been selected on this prior tab. So if I go to 4%, go back to budget tab, whoop, gone. That column M is gone, it disappears. So if I come back and I type RMD, or if I just go backwards, get my RMD, come back here, this says, okay, knowing that you had to withdraw money, you were forced by the IRS or by Congress, whoever you want to blame, knowing that you had to withdraw money, and supposing you don't need all of it to live on, is there any amount of that RMD that you would like to reinvest, say in a brokerage account or a savings account? This gives you a chance to enter that. So let's say that you put, yeah, I want to reinvest $1,000. And I'll just for convenience, I'll just put $1,000 all the way down. It probably is going to escalate, but just to show you the feature. And then you're allowed, because it's a bright yellow cell, that means you can change it. I'm going to reinvest that in an account that averages a 3% annual return. Okay. Well, then as you scroll over, now you have basically a view of your cash flow, not just the growth of your portfolio, not just the withdrawals of your portfolio, but the cash flow situation. How much of your monthly income is taxable? You can enter that. What's your tax rate? You can enter that. And then finally, maybe one of the most important columns is, what are your retirement monthly expenses? Okay, well, right now, I've got $6,500 entered as the monthly expense. Well, what that is saying now in the next column is that, well, you're going to have a deficit, and your monthly deficit is about $3,300 because your net monthly income is $3,158, given all the data you've provided, and your monthly expenses are $6,500. That obviously leads to a deficit. Why is that happening? Well, because Social Security, in this case, is not starting until year 4. If we started in year 1, then we would enter a 1 here. Now we go back. So if that's the case, if Social Security has already begun, now the deficit is dramatically smaller. It's only $1,000 a month. So what do? Well, either that's the reality, or you say, you know, I think we can get along with $5,500 for the first couple of years. All right, that turns that deficit into basically non-existent. And you have a small surplus each month in year 2, a little bit bigger surplus each month in year 3, and so forth. These next several columns, all they do is they transform all of these previous columns that were based on monthly data to annual data right here. So it becomes annual numbers if that's easier for people to envision. All of that leads to these 3 columns, well, these 4 columns right here. This is really where it all culminates. This column. What is the cumulative surplus or deficit of your annual surpluses or deficits? Well, by the end of 25 years, if your budget figures are anywhere close to being accurate, if your income figures are anywhere close to being accurate, you've got about a 1.6 million that has accumulated in budget surpluses. You may say, oh, that is totally unrealistic. How can I modify that? That's not going to happen. Well, let me show you a way to do that. Since we're already in a spreadsheet, we can use the features of a spreadsheet. So here I am in column T. This is the monthly expenses for me, or my household, or whatever group you're thinking about. And here is your, in column Q, this is your estimated total monthly net income after tax. This is your take home. Whoops, that was weird. This is your take home pay right here, column Q. So one option is to simply say to the spreadsheet, I press the equal sign. I want to tell the spreadsheet that my monthly expenses will be 95% of my monthly income. So I enter Q10, which is this cell right here. That's my monthly net income, times 0.95. Bingo. That says I'm forcing myself not to overspend. If you think that's realistic, All you have to do is grab that little corner, copy it down. It copies that formula, and it says, for every year, I will spend 95% of my income. Okay, now that may not be the reality, but it's probably closer to the reality than what was entered there before. In other words, the reality is going to be lived out in shorter time frames. We don't sit down, enter our data into a tool like this, and then say, okay, well, I'll come back in 25 years and see how things look. That's not how we do things. We'll come back in a few months, kind of evaluate, maybe another year. So these expenses can be modified and made more accurate in real time in our lived experience. Well, with that approach, our budget surplus after 25 years is about $175,000. That's probably a lot more reasonable. Our estimated balance of our retirement portfolio is shown right here. It is growing, and then it starts to taper off right there in year 25. It's starting to show some of the stress of the escalating RMD percentage withdrawal rate. And then in this last column, this is the growth of our reinvested RMD. We're going to have a little shy of $500,000 right there in reinvested RMD. So between the surplus of our annual budget, our spending and income, plus the estimated balance of our portfolio in year 25, plus the estimated balance of the RMD is this number right here. That is the estimated total accumulated capital, which is a function of three numbers: budget surplus or deficit, portfolio, retirement portfolio, and reinvested RMD, 2.57. Now we go back to the 4 asset tab. There's that number right there, 2.57. That's the estimated total accumulated capital after 25 years. But with this important note, it's dependent on the budget data. It's absolutely dependent on the budget data. This one scenario that we've done, I would think would be very motivating, very comforting, very calming, because we have a 100% success rate. 92% of the time our portfolio grew. On average, our portfolio balance doubled. We have, in average, over the quarter century, almost $11,000 a monthly income. But remember, that monthly income being withdrawn from the portfolio is that average is, it's truly an average, but you went from $3,100 a month withdrawal to almost $22,000 a month withdrawal. So the average can be, like all averages, a little bit deceptive. And that's why this particular column in the budget tab is so important to be attentive to. Not that you can control it in this tab. The only place you can control that monthly withdrawal is back over here. And you might say, you know what? It's not RMD. It's not 4% or 5%. I want to do, well, let me enter a 0. You have 4 options here. So if I put a 0, then that gives me the choice to now enter withdrawal data based on how many dollars, not a percentage, but how many dollars I take out. Okay, so in this case, my first withdrawal is 60,000. And then I enter a 4% COLA. I want a COLA, and my default COLA is 4%. All right. Now down below that, you can put some guardrails on that COLA. First, you have a downside COLA, and then you have an upside COLA. So read this sentence right here. If annual portfolio return is blank or lower, this is my COLA. Well, this is 0. So what I'm saying here is if my portfolio return is 0 or lower, AKA negative, my portfolio has a loss, my COLA is 0, let's say. If my portfolio return is 10% or higher, let's put it 8% or higher, I have a COLA of, say, 4.5%. And maybe I change my default COLA to 3. So my COLA is going to be 3 unless my portfolio return in any given year is below 0, in which case it'll be no COLA. On the other hand, if my portfolio return is 8% or higher, I have a 4.5% COLA. Now that's a very different approach to how money's being taken out. Now my average withdrawal is 91,000, almost 92,000. My balance is on average after 25 years about 2.6 million. And my total accumulated capital is 2.8 million. Okay, that happens to be pretty similar to what it was when we had RMD. It was 2.6 million. The other option as to how you dictate money being withdrawn is to enter the word custom. So you have 4 options. You can enter percentage, like 4, okay, or you type in RMD, just the letters RMD, or you type in 0, which we just did, and that gives you this control over the cash, hard dollar withdrawals. The last option, as it shows right here, is custom. So I enter the word custom, I scroll down, and now it gives me control of how many dollars I want to withdraw in each year. Or I go up here and enter a 1, and now I can enter a custom percentage that I withdraw each year. And I've just got these goofy numbers, 5% and then 4% and 3 and then 2. And you see what it does to the withdrawals over here in this graph. They're just all over the place because you keep modifying the percentage. Whereas the portfolio balance isn't nearly as dramatically affected. But the annual withdrawals obviously are affected materially because the driver of that is being moved around in kind of a ridiculous way. So maybe more logical, some people have this thought, I'm going to withdraw 6% for the first few years and then 5%. It's going to have like a reverse RMD, and then 4 for a bunch of years, and then, whoops, that's a little high, and then 3, because I believe my portfolio balance is going to grow, and the 3% withdrawal will be adequate for those later years. So this is, like I said, this is kind of a reverse RMD, a little higher withdrawal rate while you have better health, let's say, you're doing more traveling. You can model that. You come up, oh, that works out pretty well in a 60-40 portfolio. The average withdrawal is about 77,000. And here's the flow. This is all 76 different people, so to speak, and their experience of withdrawals. Then you have their balances over here in the blue graph, and they're generally growing. In fact, they're always growing. 100% of the time, it grew. The portfolio grew. The average ending balance, 3.6 million. Wow, that's doable. So to the question, can I do kind of a reverse RMD? Yeah, and the RMD are right here, you know, if you want to see them. So that's a pretty intriguing option to really do some customized test driving of a portfolio. There's more tabs to show you, but because I wanted to kind of highlight what's new, I also, for those who have experience with the RPA, I think you're going to enjoy this. Here's the 7-asset portfolio. We don't have as many time frames to study. We can only go back to 1970. We only have 32 rolling 25-year periods, but we do have more asset classes. So let me make that a little bit bigger for you. We have large stock, small stock, non-US stock. That wasn't in the 4-asset tab. Bonds and cash, those were real estate. That's new. Commodities, that's new. So you have more asset classes to reflect a more diversified portfolio. And then new this year is the 7 asset budget tab. I don't know why it took me so long to introduce it, but it's the same approach as we just saw with the 4 asset portfolio budget tab, but now it's drawing the portfolio withdrawals from the 7 asset portfolio. So I think that's really a valuable addition and improvement to the software. So because if you prefer to be in the 7 asset tab, you now have the ability to fully complement the 7 asset portfolio data with your actual best estimates of your overall budget picture. It's 12:11 my time, Mountain Time. I feel like maybe we should take any questions, if there's questions at this point.
Craig, we have a number of really great questions. A lot of our viewers today, many of them are focused on inflation. Can you talk about inflation assumptions in the portfolio?
Yeah, you bet. So the inflation tab right here. Let me click on that. So this is now drawing upon the 4 asset portfolio. Let's go back to RMD because that impacts a lot of us. I'll stay with the 60/40 portfolio for now, but I'm going to click on the inflation tab. Okay, so here's my approach to that. So here's all the data that was entered in the main tab, the 4 asset tab. You have $1 million starting balance, you're 73, you have a 60/40, the RMD is driving withdrawals, and you have 20 basis points of portfolio cost. Okay. So when we think in terms of the inflation impact, here's one way to look at it. Previous, we were looking at numbers that were gross. So 1.956. So if you go back here, 1.956, here was the average ending balance after 25 years on this main tab. When we consider the impact of inflation, and this is actual inflation, and so let me interrupt myself. Let me go here to the annual tab. The annual tab then shows the inflation every year. Actual CPI inflation from 1926 all the way down to 2025. Here's all the data that's driving everything in the analysis. All the year-to-year returns of large stock, small stock, bonds, cash, and inflation. And then next to it is the portfolio returns based on how you allocated across these 4 asset classes. So here's the CPI data that we're actually working with now in this inflation tab. So what's the real or inflation adjusted balance of 1.9 million? It's 793,000. That's the inflation, that's the purchasing power of a balance of 1.956 million, 25 years hence. So is that discouraging? No, that's just reality. You still have $800,000 of purchasing power. Inflation is going to happen. Inflation is not going to stop if we're concerned about it, if we don't like it. It's like humidity in the Midwest where we used to live. It just happens. And so we just deal with it. The average annual withdrawal was 128,000 gross. The needed annual withdrawal to keep pace with inflation was 60,968. So those withdrawals did a great job keeping pace with inflation. This is a tricky thing to analyze, and this is how I've chosen to do it, is to display the actual dollar-based withdrawal in contrast to the withdrawal needed to keep pace with inflation. And then there's ways to graphically look at it. So let's do this. Here's the first graph. So over these 25-year periods, where we're using the actual CPI inflation for each rolling 25-year period, I'm not looking at the average inflation over a 25-year period. I'm looking at the year-to-year inflation as it actually occurred over rolling 25-year periods. The blue bars represent the total withdrawal needed in that 25-year period to keep pace with inflation. The green dot and the associated lines connecting them, that represents the actual total 25-year withdrawal. And you'll note that the actual total withdrawal in every case, in all 76 rolling 25-year periods, exceeded the needed amount to keep pace with inflation. Or, viewed differently, here is the median portfolio return each 25-year period. And below that, in the bar graphs, is the median 25-year inflation growth rate. So every 25-year period, you can isolate that and say, okay, what was the inflation growth rate during that 25-year period? What was the median? And you'll notice, as expected, that the highest rates of inflation were in that basically we're covering the 70s and 80s right in here, 1970s and 1980s. Then it's tailed off, and over the last, a dozen rolling 25-year periods, we're down now to about a little over 2% median inflation growth rate. So that's with the RMD. If we come back and we change that to 4%, now we go back to the inflation tab. Okay, now we withdrew 88, almost 89,000. 71,000 was needed to maintain pace with inflation. We come down here, whoa, so this now begins to tell a different story. 71% of the time, our total withdrawal over each rolling 25-year period kept pace with inflation. So whenever the green dot is below the top of the blue line, in that 25-year period, we did not keep pace with inflation. And so that while that sounds discouraging, it's often pretty close. Like right here, you're very seldom way below the needed withdrawal to keep pace with inflation. The closest or the worst is probably right here. You withdrew 1.9 and you needed to withdraw 2.2. So that's at least my approach to how we visualize and think through inflation. And I would say in general, let me show you one more. So if we went to the 0, and now we do a cash-based withdrawal, now we go back to inflation, and it's a much weirder graph. When we force a dollar figure, it's kind of blind, and that's what we've done. We've forced a dollar amount with a assigned COLA, and it's a little bit optimistic of us to know, what that is. Whereas a percentage based is more dynamic. Let me show you one more thing though. Let's say we went to a $50,000 withdrawal, and instead of a percentage, I just type in CPI right there. So if I type in CPI, I've told the RPA a very different thing to do, which is I want you to introduce a COLA that is equivalent to the CPI. Whoa, now that's direct. So now, look at that. The green dot matches, the green dot is the actual withdrawal, and the blue is the withdrawal needed to keep pace with inflation. And the only time that it failed was these 2 years right here, and what must have happened, we must have had a failure. We did, right here. When these lines dropped down to 0, that means in those periods, we actually depleted the portfolio. We see it right here. We have a 97% success rate. So apparently 50,000 with a CPI kicker for the COLA is a little heavy. So I go to 45,000. Oop, there we go. I got those failures to go away. So I go up to inflation. Whoop, we solved it. So that's another aspect of kind of the test driving you can do. If your greatest fear is inflation, then you can use this approach, have CPI be your COLA, and then you're going to have to fine tune if you're wanting to do a cash-based forced withdrawal. You're going to have to find that whatever number you can live with, and how it relates to success rate. You know, if you kill the portfolio, if you said I want 75,000 in year one, and then I want a CPI COLA, you know, every year thereafter, look at all the failures. I mean, you killed the portfolio almost half the time. You had a 58% success rate, meaning 42% of the time you drove the portfolio to zero. So that tells you, whoop, that won't work. and the test driving begins. Great question.
Okay. Should we answer one more question?
Sure.
Okay. In terms of an application, how would you use this to optimize future Roth conversions?
That's tricky. That is a good question.
Yeah.
So the Roth conversion we have to make some guesses as to future tax rates. So I almost would ask the question back, how do you propose we do that? You know, and I'm saying it with a twinkle in my eye. I'm not being a smartass. That's pretty tricky. But there are some ways to think through it. So the whole Roth conversion question really centers on how quickly, you know, over how many years do I make those conversions? And then the tax implications of that. And so you could have, for example, you could go into the 4-asset, let's say you have $1 million, and you say, okay, I want to withdraw 10% a year. And that 10% withdrawal is way more than I need to live on. And what it reflects is I want to really draw down the portfolio heavy, but I don't want to necessarily do it for 10% every year. Well, if that's the case, then type in custom, come down and say, okay, I want to withdraw 10% this year, 10, 10, 10, 10. So for 5 years, maybe that's 6 years, I withdraw 10%. Okay, and then after that, I do say a 4% withdrawal. So I just copy 4% all the way down. So those 10% withdrawals are expressly with the Roth in mind. Then I come to the budget tab. Okay, so this shows me the average monthly withdrawal right here. Notice in those 6 years, that is way higher than in year 7. So in year 7, it plummets down to 3,400 because my withdrawal rate went down to 4%. That's really what I intend to do. But these 10% here are telling the spreadsheet doesn't know that you're thinking in terms of Roth. It's just applying mathematics. But you know behind the scenes that you're entering 10 because you have this Roth in mind. You would then need to consider, okay, so if I did 9,200 a month, so let's just make this easy. The average there is about 8,900. So that's about 9,000 a month times 12 times 6 years. That's $650,000. Is that the amount that I'm wanting to roll? Okay, let's say it's close. And then you would tinker with the tax rates, if that pushes you into a higher marginal tax rate. And you have the portion that's taxable. You then can manipulate the tax rate to reflect what the Roth has bumped you up to. That would be scenario A. And then you've got all this money now converted to Roth after year 6. You would then modify the tax rate starting in year 7 to maybe 10%, because you now have Roth money that you can take out. A portion of your total income is now not tax exposed. That's the best way so far I've thought of is to deal with it is within the budget tab, and to basically just play different scenarios based on what withdrawal rate would be required to do the amount of money you're intending to convert, the impact on the tax, both during the conversion and post-conversion, and then you could compare that to not doing a conversion. Just leave things as they are. And so you would do 2 different scenarios using the RPA tool to measure sort of bottom line difference. And it's going to be gross anatomy. It's gross surgery. There's just too many variables involved in terms of the tax rates to feel like, this is brain surgery. This is not. This is fixing farm equipment with baling wire. And simply because how can we possibly correctly estimate the tax rate 15 years from now? We don't have that insight.
That is a great way to approach that problem. Thank you. I think that wraps everything up for today.
Excellent. Good. Thank you so much, Craig, for a fantastic presentation. I was really happy that you were able to, get through so much, kind of background information, and then also do the live demo. So I really appreciate your time, and we always love working with you, of course. And thanks so much to Cindy as well for facilitating our great Q&A. We got so many questions in. So if we didn't get to your question, I put it in the chat, but please email us at members@aaii.com. Craig, Cindy, do you have any last thoughts or anything that you want to share with the audience before we kind of sign off?
Yeah, my favorite wisdom is from a mutual fund manager named Ron Mullenkamp. He said, if you want to take volatility out of your portfolio, check it less often.
I like that. That's good advice.
Very timely. Thank you.
Excellent. Well, the RPA, first of all, is an extremely valuable tool. I think every investor can see that. And it's really good to have, tools like this in your retirement planning arsenal. It really brings a lot of clarity to the entire process, and it's a great way to visualize, where your retirement portfolio is standing and the impact of your decisions before you make those. But I know we threw a lot of information at you, so if you have any questions about the RPA or specifically about the 2026 updates, you can feel free to email Craig at craig@aaii.com. If your question is more general about pricing or membership or anything like that, please direct those questions to members@aaii.com. And then, like I mentioned before, we're offering all attendees a chance to purchase RPA at a $50 discount. We partnered with Craig on this, for the last couple of years, and we're really happy to continue offering that. So the RPA tool costs regularly on $150, but for those who are associated with AAII, you'll get it for $100. And then you can use the order form that we put in the handout section of your GoToWebinar control panel, but we'll also email that to you in that follow-up email later this week. So yeah, if you'd like to purchase RPA, please complete the attached handout and then email craig@aaii.com. And then somewhere just put that you're affiliated with AAII so we can give you that discount. And all questions, like I said, about the RPA tool specifically can be directed to Craig at craig@aai.com. And then lastly, just because we got a lot of questions about this, this presentation was recorded and a replay will be available on our YouTube channel as well as on our website at aaii.com/webinars. You can find all of our upcoming and past webinar events there. And then webinar attendees, like I mentioned earlier, will receive an email with the link to today's recording later this week. In that email, you'll also receive a copy of our presenter slides, as well as links to any other resources that we discussed today. And with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you so much for joining us, and take care.
Bye. Thank you.